Okay, what if I told you there's a secret financial cheat code the super rich use to get multi-million-dollar life insurance policies without spending a single dime of their own money? Sounds amazing, right? Well, today we're pulling back the curtain on a strategy so controversial, it literally triggered a massive federal investigation. Let's get into it. Just picture this for a second. You're in a beautiful, sunlit office. You're signing the papers for a huge life insurance policy. But here's the kicker. You're not paying for it. A bank is. This means your cash stays in your investments, hopefully making you even more money. It's the ultimate have your cake and eat it too financial flex, sold to the wealthy as a way to get protection while keeping their capital hard at work. And this is how they sell it. Look at the official pitch here. It's all about giving you more control over how you use your money. They'll call it a smart solution, a strategic approach. I mean, come on. It sounds absolutely perfect. Almost a little too perfect, you know? But what if that cheat code was actually a virus? A virus designed to wipe out your entire financial hard drive. That's the real question we're asking today. Is this the greatest wealth hack ever invented? Or is it a perfectly designed financial trap that could leave you with nothing but a mountain of debt? To figure that out, we have to dive into a real-life financial horror story. We're not talking about theory here. We're talking about a scheme that the courts eventually called something way, way darker. A multi-million-dollar death bet. This scheme actually has a name. Stranger-originated life insurance, or STOLI. And seriously, STOLI sounds like a terrible new streaming service, right? But according to the U.S. Court of Appeals, it's actually a speculative investment device that entails gambling on the lives of the elderly. Yikes. That's a pretty heavy way to describe a financial product. And that brings us to our main character, a guy named Barton Cotton. So in 2007, he gets into one of these deals. By 2008, a $5 million policy is issued, but, and this is a big but, he had to lie on the application, hiding that a company called Imperial was financing the whole thing. Then the story takes a wild turn. In 2010, he's diagnosed with terminal cancer. And just like that, for the investors gambling on his life, his policy becomes a winning lottery ticket. But when he dies in 2011, the insurance company says no way and refuses to pay, claiming the whole thing was a fraud from the start. And that's when the lawyers get involved. And this slide just perfectly shows the disconnect. The pitch was a smart solution, but the court called it a scheme. They said it would preserve your use of capital. But the reality was loans with oppressive terms. And my personal favorite, what was sold as a strategic approach to wealth building, was later just called fraudulent behavior. It's like ordering a Wagyu steak and getting served a shoe. So, how does this sophisticated dream for the rich turn into a total financial nightmare? Well, it all comes down to the math. And trust me, this is where things get really, really ugly. Okay, so Barton Cotton's trust takes out a loan to pay for the insurance premiums. The initial amount they borrow, $335,000. Seems pretty straightforward, right? A loan for an asset? Happens all the time. But this is where the trap springs. Thanks to substantial fees and absolutely insane interest rates between 11 and 16%, in less than 2 years, that loan had ballooned to over $500,000. That's an increase of over $220,000. Look at my face. This is the face of financial pain. Now, you might be thinking, okay, that's just one crazy court case about one guy. But you'd be wrong. This isn't some rare, isolated incident. This is a systemic risk that's baked right into the product. Just take a look at this case study of a client they called Mohammed. He had a similar deal, but then interest rates spiked. All of a sudden, his payments just exploded. He was paying the bank $277,000 a year just in interest. That's an increase of almost $200,000 a year. It's like literally setting a pile of your own cash on fire every single year for the privilege of owning this thing. So here it is, the 4-step playbook for financial disaster. Step 1, interest rates spike and your loan payments go to the moon. Step 2, the policy itself doesn't perform. That magical growth they showed you in the brochure, total fantasy. Step 3, the lender hits you with a margin call, demanding you pledge more collateral. We're talking your house, your other investments, everything. And finally, step 4, you can't pay. The lender forecloses, the policy implodes, and you're left with nothing but a giant debt. Game over. So let's get back to the Barton Cotton case. After all the lies, the crazy debt, the tragedy, what actually happened in the courtroom? Welcome back to the financial war zone. So the jury actually finds in favor of Cotton's family. They get the $5 million death benefit plus fees. Sounds like a win, right? But hold on. Look at the lender, Imperial. They still walked away with $2.24 million to pay back their ridiculous loan. It was only after that the judge, who was clearly fed up, slapped them with an extra $850,000 fine for acting in bad faith. And this is exactly why the judge was so angry. The court literally found that Imperial coached their witness to be an expert on all the facts that helped their case, while being conveniently dumb about harmful ones. I mean, that is some next-level shady behavior, and the court saw right through it. Okay, so this has been a wild story about millionaires and sketchy lenders. But why does any of this matter to you? What does this have to do with your wallet? Let's connect the dots right now. This isn't just a billionaire problem. Check out this question from a regular person on Reddit. What's the catch with this? Why aren't more people setting up policies if it's so good? And that right there, that's the million-dollar question, isn't it? People are hearing the slick sales pitch, but their gut is telling them something just isn't right. So here's your survival guide. 5 massive red flags to watch out for. 1. It's pitched vaguely as some kind of tax shelter or retirement plan. 2. The sales charts showing you how much it'll grow look way, way too good to be true. 3. You feel pressured into premiums you know you can't actually afford. 4. The fine print says the lender gets total control. And the biggest one of all, they require you to pledge your other assets, your home, your investments, as extra collateral. If you see any of these, just run. Which brings us back to the big question. Is premium financing a sophisticated tool for the ultra-wealthy, or is it a loaded weapon pointed directly at your life savings? Because, as we've seen today, the answer really depends on who's pulling the trigger.